Swayam Prabha. Digital India. Educated India.
Which can also be written as P is equal to A over 1 plus I, then present discounted value of A, which I will get one period later, is P. So, something which I will receive tomorrow, for which I will have to wait. If I want to know its value today, it's called present discounted value, which is P, which I have with me today, all right, will be A over 1 plus I, where discount is done by the interest rate. If interest rate is 0, they are equal, and I is called the discount factor. Now, this is a one period thing. For 2 periods, in this formulation where interest rate is paid every period, for 2 periods it will become, after 2 periods if I get this, the present discounted value will be 1 plus I to the power square, where the interest is paid every period. So, the present discounted value is often used in the financial market discussion. We will learn a lot about that and many other things in the financial economics course. All I am telling you right now is that in this simple discussion on interest rate, you see how interest rate plays a very important role, both to calculate what will happen in future and also to get the future values converted into present value. One is going from here to future, one is trying to calculate the future in terms of the present, which is called present discounted value. Interest rate is very important. Now, I also mentioned that interest rate often bothers people. Say, sir, why you discount only by interest rate? In future values can also be discounted in terms of inflation rate, because inflation reduces the value of future. So, the value today of a future thing when there is inflation is even much less if inflation is added. Then I said, well, I is a nominal interest rate, where a nominal interest rate according to that Fisher definition, which we use in macroeconomics, is I is equal to real interest rate plus inflation rate. And often the inflation rate is, which did not happen, is the expected inflation rate. So, you can have an expected inflation rate there. What do you expect? So, inflation rate has been considered in this formulation. This is what I was trying to tell you in the previous class. Now, if you go into areas like cost benefit analysis of a project, where you incur costs for 5 years and then the returns will come after 5 years, a much more complex discounting goes on there. And there are concepts of private discount rate, which is this one. There is a concept of social discount rate, because in the context of a project it has a social relevance. So, what is the social discount rate? With environmental economics being alive, you have also environmental issues coming into the picture as to what will be the discount rate, and you can imagine with environmental costs associated with a project, say a thermal power plant, etc., the discount rate even becomes heavier, fatter. So, you add I plus some more things. So, it is heavily discounted. All right, you can get into many discussions. I need not go into it. My objective here is to bring out the story about interest rate. So, this is a simple interest rate. All right. Now, I go into the other things. There are various kinds of loan bearing instruments which are called debt instruments, and various kinds of loan repayment schedules that are used by the banks. For instance, you must have heard that somebody has taken a loan for a car or for a house from a bank, pays an EMI. You must have heard of that expression, EMI, equal monthly installment. What happens there is not this kind of a picture, where in case of a 2-period loan, you either pay the interest at the end, so interest on interest accumulates as a cost, or you pay interest rate after every period and then repay the principal at the end of what you call the maturity of the loan, the term of the loan. All right. Now, EMI, when EMIs are calculated by banks for you, that this is what you have to pay towards your 10 lakh loan, 20 lakhs loan, or whatever you have taken, then what happens is that the EMI contains both the periodic interest payment, part of it may be, and part of the loan. So, part of the interest is not paid, on which again interest accumulates, and the bank gives you a schedule like this 10 lakh rupees loan, you will have a 10-year period EMI, and each EMI that is equal monthly installment will be this amount of rupees. That amount of rupees you have to pay. Bank calculates that, all right, by whichever means, they have a formula. This kind of a EMI situation, which is very common with bank loans and mortgages, etc., which are used in the Western world. You buy a house which is mortgaged to the bank, and you pay an EMI. Once the loan interests have all been paid to the bank, then the house becomes yours. Otherwise, the house ownership remains with the bank. All right. So, loans, various kinds of loans and mortgages, EMIs are used. This situation of EMI is known as, in the literature, you can refer to Mishkin, it's called fixed payment loan. Fixed payment means fixed repayment schedules, EMIs, equal monthly installments. They are also, there is an expression, it's there in the book, I really don't understand the entire meaning of it, fully amortized loan, it's also known, in which the borrower of a loan must repay a fixed amount which covers every period that consists of a part of the principal and a part of the interest for a set number of years. All right. Fixed payment loan, that's the EMI business, which is very common. The example I had initially is a very simple example. I started out with it, which is taught in middle school, secondary school, you know, these interests, simple interest, compound interest, etc. The one which also interests us is a very interesting thing, which is very common, you will find in this course and in other areas of financial economics, etc., is known as a coupon. Now, what it means, essentially a coupon bond, if you buy a coupon bond, there are various kinds of bonds, I am coming to that. What is a bond? It's a debt instrument. Somebody borrows money, say the government or a company borrowing money from you, selling coupon bonds which you purchase. What do you get? Every period you get an interest payment which is fixed, which is in fact written on the bond paper, known as the coupon payment. Coupon bond has features like fixed interest payment, which is also known as the coupon rate, fixed interest payment, or the coupon rate or the coupon payment. All right. Next, A coupon bond also specifies the fixed amount, the final amount which will be paid at maturity. Specifies an amount to be paid, to be repaid at maturity, which is usually repaid at maturity, which is usually equal to the what is known as the face value of the bond. This is the face value. So every bond paper has something, just not the 10% coupon rate mentioned, which is the interest payment, but it also mentions a face value, 10,000 rupees, 1,000 rupees, 5,000 rupees. It is mentioned, which you will get back from the seller of the bond. It may be government, it may be a private company, it may be a semi-government organization like railways, electricity corporations, various kinds of infrastructure bonds are there, coupon bonds, various kinds of bonds are there in India also. All right? Achha. Another thing which I should have mentioned, fixed interest payment and specifies an amount to be repaid at maturity. There is another thing that is always mentioned, is that it specifies the maturity period. So it is a 5-year bond, it's the 5-year bond or a 10-year bond or a 20-year bond. It's on the bond paper, coupon bond. All right. And most important, another important thing, if not the most important thing, is that it always mentions the issuer, name of the issuer of the bond. So issuer of the bond, who sold it, it's mentioned on that. So if Government of India has sold this bond to you, Government of India would be written. UP government has sold it, UP government will be written on it. Tata Corporation has sold, say Tata Consultancy Service sold some bonds, it will be written on it. So name of the issuer is also a very important feature of these bond papers called coupon bond. It mentions the coupon rate, that it promises annually a 10% interest income. So on the face value you get a 10% interest income. So on a 1,000 rupee bond you will get 100 rupees every year. It mentions the maturity period, how long it is, and at maturity usually it is assumed, this is not very important, it is understood that the face value of the bond will be given to you. All right, that money will be given to you. All right. Now I am coming to a very interesting aspects of these coupon bonds. Before I do that, I come to they develop a secondary market. It's very interesting. They develop a secondary market, these bonds. And like I bought the bond in 2010. It's a 5-year bond, but in 2012 I decided to sell it. I can go to a secondary market, sell it. Question is, what price do you sell it? Is the price 1,000 rupees which you paid to the government when you bought it, face value? Or is the price more than 1,000 now you pay? Or is the price less than 1,000? 3 possibilities are there. When you're going to the secondary market, there are 3 possibilities which is there. At what price? If the bond is very attractive and 3 more years interest income is very good, it may be sold in the market at higher than the face value. And if the bond is not very attractive, which is happening in European countries, government bonds have become less and less attractive, it may be sold at less than the face value. All right. So when you sell it, you don't get 1,000 rupees, which you would have got at the end of maturity. You would get maybe 800, 900, 950, whatever. And all this has implication for another kind of interest rate. I'm coming to that, which is happening in the Western world a lot. In India also we will study this kind of coupon bonds, what the interest rates are. So every kind of debt instrument has an interest rate associated with it. Problem of a macroeconomist is, which is the interest rate shall he consider in his study? ISLM model में interest rate है, कौन सा interest rate? अच्छा. So these issues are there. Let me go into, before I go into that secondary market business, which is very important, the share secondary market, capital market, which is called. Financial market has two broad markets. One is the capital market, one is the money market. I would study money market here. The capital market, you have to wait for the financial economics course, which is coming in 4th year. That I won't study here. That's again an area, specialized area. All right. So together, it constitute a nice package for you. That's it. Now, there is a type of coupon bond which is very interesting, and you would be surprised to know the name of it. And you would wonder, sir, what this nonsense is all about. It's called zero coupon bond. Now, this is very popular, zero coupon bond. Now, at zero coupon, for a zero coupon bond, usually they are short term bonds. Zero coupon bond, the coupon rate is 0. That means it promises no interest to you. Then you wonder, sir, why do I buy the bond if it doesn't pay me any interest rate? Well, what happens with the zero coupon bond is they are sold to begin with at a discount. So, 1,000 rupees zero coupon bond will be sold to you for 950 rupees by the issuer. Now, you wait 1 year, they are very short term. After 1 year, you get back the face value of the bond. So, you make a gain of 50 rupees. It does not promise you any interest, annual interest income. They are called zero coupon bond. Coupon rate is 0, coupon value is 0. Amazing stuff. First, when I heard that, I had real trouble understanding it. Zero coupon bond does not promise any interest rate. It is not like a regular coupon bond, which promises a 10%, 12%, 5% fixed deposit account. Fixed deposit account, exactly like this. It promises you an interest payment for 2 years, 3 years, annually you get them. All right? Now, zero coupon bond is very popular. Short term bonds often sold by government, etc., to collect some money, but they are sold at a discount, and that discount rate at what reduced price depends upon the market demand for it. So, it's a demand supply which works there. If the demand is very high, then the discount rate will become very small. The government takes advantage of it. But if the demand is low and government is at बेचारा रुपया चाहिए ये संसार चलाने के लिए called government, तो वो हाई डिस्काउंट में वो कूपन बॉन्ड छोड़ दे, जीरो कूपन बॉन्ड छोड़ देते हैं बाजार में. No. Face value is always the 1,000 rupees to 2,000 rupees. Face value is the value of the bond written on the bond paper, which you get at maturity.
Sir, if I get the discounted price at 950 rupees, I pay that price, and then after 1 year the bond is sold at less than face value.
Not sold, given it is redeemed.
Go to secondary market and
Oh, secondary market, yes. Secondary market, again you have to negotiate a price. At what price you would sell it?
but then what does face value signify?
Face value is the holder of the bond, whoever it is, the nth holder of the bond, at maturity what he gets from the issuer of the bond as a principal. In case of a loan, a principal which is repaid to the lender. When you take a loan, not only you are paying interest throughout, you repay the principal. Here the principal is the face value, which is written on the bond. Bond is like a share price. Share is very similar. Share, there is a face value of the share, 10 rupees. Every share certificate has 10 rupees. Now, if you keep your eyes open, you hear that somebody had an IPO, which is initial public offer of a new share, sold at 250 rupees, that 10 rupee share certificate. And you wonder, 250 rupees, why are they buying it? Because the share face value, share certificate face value is 10 rupees usually. Share certificates are always, what I have heard, I don't know abroad what happens, maybe $10, maybe $1, I don't know. Here it is 10 rupees, but sold at 250 rupees. So, the company is really riding a horse, it cannot be horse, a spaceship towards maybe the planet Venus or something, and making a huge amount of income on its way. 10 rupee share certificate initial offer, public offer went in the market because the demand is so high. Why is it so? The simple reason, the market value of the company is very high. Market value, there is a way to calculate that. I'm not going to into capitalist, I'm not going to go into capital market discussion here. These are all capital market issues. But the face value and the market price can be very different. That's what I'm trying to say. Open Mishkin. So the face value usually happens is that in case of a bond, not in case of a share. In case of a bond, what happens is at maturity, say 10-year period, when 10 years has gone by, you go and surrender that certificate, somebody else may have bought it. 10 hands it has gone through maybe in 10 years. And now you hold it, all right? So you take it and say, now this has matured. They will immediately return, if there is an interest payment to be made at the last year, they would, and the face value of the bond. In case of a share, it doesn't happen. When companies recall shares, companies can do that, all right? Winding up, say they have 10 million shares, they decided to wind up 50 lakhs. They don't give the face value necessarily. They give them a market price which is usually higher than the face value. So in case of bond, it doesn't happen. When it matures, which the fixed period is there, very important. Shares have no fixed period, by the way. But bonds have a fixed period. Debentures, another name for bonds, offered by private companies, have a face value, have a fixed period, a maturity period, definite maturity period. Shares, you can buy and hold shares for your entire life maybe. Some company, all right. So zero coupon bond are this kind of a thing which are sold at a discount. I don't know, I think this is true. Government usually uses something called treasury bills to collect money. And I've been told treasury bills are often sold at a discount. And it doesn't have a fixed interest payment. I may be correct, may not be correct, because I've never bought a treasury bill. So they are like zero coupon bond. But there are zero coupon bonds available. Now, whether it is a zero coupon bond or a government bond, whatever, the thing is, you can always calculate at any point, say a bond has a life of 10 years. After holding it for 2 years, buyer A decides to sell it off. Now it goes to buyer B. And B can calculate the return he will get for the remaining 8 years. And also use that calculation in deciding what price he should pay to that seller, which is buyer A, originally bought from government. So at every point, some present discounted value of the return on that coupon can be calculated. He was talking about tomorrow what happens. Say you take a treasury bill. I will talk about treasury bill in this course. There are 90-day treasury bill. At one point, India government issued 14-day treasury bill. Unbelievable. Such a short-term instrument. 14-day. After 7 days, somebody can sell it off. Understand lock-in period. You cannot sell it off in the secondary market for some period. And then you can go for a secondary market. There can be a lock-in period. In mutual funds, there are often lock-in periods. You buy UTI units, SBI Magnum, they say 3 years is a lock-in period. It's a 10-year kind of a mutual fund certificate. 3 years is a lock-in period. So for 3 years, you cannot do anything. After that, you can sell it off. And often what happens, you sell it to the issuer, back to the issuer. Achha. Now, so at every point, you can calculate, or there's a possibility of calculating the present discounted value of that, all the return that awaits me, I will get if I buy it today. Already 2 years have lapsed because it was with somebody else. So a market price develops. This is a secondary market price. Now, an interesting measure appears here. Suppose a bond which promises a fixed interest rate 10% every year. So for 8 years I will get that. And at maturity I will get a principal. Now for these 10 years return, I can obtain a present discounted value for the 10-year period, for 8 years that I will receive the return, plus on the 10th year end, beginning of 11th year, I will get back the principal, the face value of the bond. All right, whose present discounted value I can calculate today? Sum total of that series is something which is very important to an investor, person B. Initially, investor was person A who purchased it. B would take that present discounted value and compare that with the market price. A notion of equilibrium can be established here by saying, therefore, the market price should match this present discounted value of the series that awaits me. I will get it. All right? Okay. So, what I am trying to say, for a coupon certificate, and you are trying to purchase it, whether to purchase it or not, there would be a price which is not 1,000 rupees, which may be less than 1,000 rupees because it is a discount bond, it is sold. You would equate that price to, you would equate that with all the coupon payments that you will get and their present discounted value for, if it is a 10-year bond, then it will be, suppose this coupon payment, if it is, suppose, let me rephrase the problem. Suppose I buy a coupon bond at a price, is a competitive price that is developing, all right. Now, I have 10 periods or say 8 periods left, 2 periods have gone by already, somebody is selling it at a price. Now, I want to know whether that price matches all the return that you will get for 8 periods plus the face value of the bond which I will get back after 8 periods, which will be the end of the maturity of the bond, which is a 10-period bond. 2 periods already have gone with the first investor. I am the second investor. This equality relationship is very important, because if P is more than the present discounted value, I won't buy it. It's too high a price. If P is less, I will jump into it, because price is less than the present discounted value of all the return I will get. So, I am making an extra profit. All right. Suppose it is equal. Suppose I am talking about an equilibrium relationship. Market has reached an equilibrium. This I is an unknown, which, given the value of P in the market and the C value which is written on the bond, 10%, so I can calculate what C is, and the face value which is written on the bond, I solve I from this equation. This becomes one equation, a polynomial, in one unknown. I can solve it. This I, you will now hear a lot on TV, is the famous, this interest rate in the secondary market that you hear, or even in the primary market, you can calculate that for the entire length of the bond, is called yield to maturity. Now, this is a very simple calculation of the yield to maturity. There can be more complex calculation of yield to maturity. Yield means a return till maturity, basically it means, till it matures. Now, in the European market, what is happening in the financial market these days on government bonds, where governments are running at a deficit, there is a huge recession, very severe recession. They are trying to sell bonds and collect money from the people to run the government. What you hear, if you open a foreign news channel, go and open in the evening a business channel, foreign business channel. You will keep on hearing some story about this yield to maturity. All right. And what is happening to this YTM? It's called YTM. What is happening to the YTM? It's going up and up. And governments are saying, my goodness, this is also called an interest rate, is going up and up. Why it is called an interest rate? Compare this discount factor with the earlier discount factors I had. It's a very similar, that's why I use the same notation, except that is asked by a bank to pay. In this case, this is solved from an equation, a variable, all right. And you can also see P and I are inversely related. P and I are inversely related. And what you hear on government bonds, yield to maturity is going up and up. What does it mean? You take a coupon bond where C is fixed, F is fixed, which government is selling, long-term bonds, and the yield to maturity on these bonds are going up and up in the market. And government is saying, my goodness, interest rates are going up and up. It is becoming more costly to borrow money. This is what the headache European governments have. What does it mean, yield to maturity going up? If C and F are fixed, I going up means P going down. That means the price at which government is selling its debt instrument is going down and down. Lesser and lesser people are interested in it. This is the sign of a typical economy where the governments are not trusted, the growth rates are negative or zero, unemployment is very high, there is not much savings in the economy, and people are not interested even in government bonds which are highly risk neutral, zero risk, because government is usually assumed to repay the money, not a private borrower, any company which can go bankrupt tomorrow. All right. So, you open a TV channel, this is the usual story you keep on hearing. What has happened to Spain YTM today? What has happened to Italian government bonds YTM? What has happened to Greece's YTM? Continuously there is a discussion and graphs shown. Now you would understand what it means. It means it is becoming more and more difficult for government to sell these coupon bonds and collect money to run the show, because the government tax revenues are not enough. There is a lot of unemployment for which government has to provide some social security, and they don't know where the money is going to come from. Economy is down, it is not generating enough income, all right. And government also is a catch-22 situation. On the one hand, because of the poor shape of the economy, the revenue coming into government's pocket has slowed down or becoming less and less. On the other hand, the demand for government is going up because of unemployment, etc., where people don't have jobs, people don't have health insurance, and they're asking government to provide that. So they cannot cut back much on expenses. On the other hand, revenues are becoming smaller and smaller, so the net result is deficit is becoming larger, and to fund the deficit, they're trying to go to the market to sell bonds to collect money, which is becoming more and more difficult. And price of anything going down basically means you can use the demand and supply model. Price of something going down means demand is less, supply is more. Very simple. Price going up means there is more demand than supply. Simple demand supply model. So the demand for government bonds are becoming weaker and weaker, poorer and poorer, whereas supply of government bonds is becoming larger because government needs money, and every now and then it comes up with a fresh supply of these papers. And also you have to realize one thing, which is a very futuristic thing. Government may be trying to cover its expenses by selling bonds today, but tomorrow it will have to repay, na? It will have to pay the interest payments, make the interest payments, it will have to repay the F value, the face value when it matures. So today's solution is a quick solution, it's not really a solution. In the long run, government has more debt. So what we see is in these countries, public debt is going up. Now you know what has happened? They have asked China to come into Europe with its surplus. Internally funds European Union doesn't have. European Union bank, central bank is in also trouble. How much the central bank can support? All these countries having all sorts of problems, except maybe France and Germany. So they are asking foreign donors. Even Dr. Manmohan Singh, when he went to a summit in Mexico, promised via IMF some $billion loan to the European Union, because they have also called the IMF to help them out. China, they are asking, they are huge surplus. China's trade is doing very well, so China has huge surplus. So they are asking China to invest in government bills, treasury bills of these European Union countries. Or they are called Euro bonds or something, I forgot what. They have one central bank now, they don't separate countries. Beg your pardon? Government doesn't. Government doesn't have money. Yeah. This is the problem. That's exactly catch-22 situation. There is no money as at the source. There is a demand for money. What has happened, if you go back into the history, there are structural faults. There have been fewer tax payments by the rich. So the tax policies are all screwed up, topsy-turvy. And there's a corruption issue in these countries, Greece, Italy, Spain, etc., where the rich have avoided taxes, which they are legally supposed to pay, even if there's less in proportionate terms. Then their manufacturing sector, these days economies have become based on service sector. Service sectors, if they go down, they're very competitive, they're in trouble. Manufacturing sector, they have ignored, which used to be their prime occupation, where China is smart, its manufacturing sector is good. So there are structural adjustment programs required, overhauling required of the entire economy. They survived on a kind of a utopian economy, as if everything is all right, but started becoming shaky. It started affecting European systems. Then the European systems, similar problems are there. They started shaking, and their weaker economies, they crumbled easily. A strong foundation will take more time to crumble. Earthquake will go like one with strong foundation will last longer. Germany is lasting a longer time. Less of a problem, less of a corruption. Germany manufacturing is still very good. We all know that. France is doing well. Britain is very smart. Has stayed away from European Union, so didn't get affected by it much. Otherwise, all this headache would have come. Say you have a nuclear family, your father runs it. Your father's income, if it dwindles, your family is in trouble. But your neighbor is not part of your family, all right, and he doesn't have any obligation to you, except some charity work maybe. Aha, बेचारा का ये हाल हुआ है. अभी एक joint family बना दिया. तो एक का प्रॉब्लम सबका प्रॉब्लम हो गया. And they are finding more and more, only there are two leaders in this whole European Union, Germany and France. Have you seen how many times Angela Merkel and that past president of France met? In the last 2 years, one could have said, you know, maybe a girlfriend, boyfriend, meeting so many times. But they are meeting to solve the European Union problem. How many times they met? I saw at least 20 times on TV. They're meeting, continuously meeting going on. कभी ये फ्रांस में जाते हैं, कोई जर्मनी में जाते हैं, और प्रेस स्टेटमेंट आते हैं दोनों खड़ा होके, कुछ नहीं हो रहा है, फंसे हैं. अरे यूरोपियन यूनियन वगैरह उन लोग का ही आइडिया था, तो फंसेगा तो ज़रूर. ये जो न्यूक्लियर फैमिली से जॉइंट फैमिली बनाने का आइडिया तो जर्मनी का ही था. Since Second World War, they are thinking about it. Anyway, we need not go into that. So what I'm saying is that this I called yield to maturity, which is an interest rate, which is now a free variable in an equation like this, which you can solve, not bank saying what I is. And in a secondary market context where P fluctuates, I is continuously fluctuating. having a concrete inverse relationship is an important indicator in an economy, in the monetary economy, which you can calculate, called yield tree. So now suppose you have a fixed payment loan for 25 years. You make a fixed payment every year, all right, and the total loan is this amount that you have got. You can equate that to the fixed payment that you get, you have to make every year, and you can make a present discounted value of that fixed payment, and you can calculate yield to I, yield to maturity in that equation also. Fixed payment divided by 1 plus I after 1 year, fixed payment second year देना है divided by 1 plus I square. 10-year period, 25-year period, आप जब कभी लोन लेंगे, EMI लेंगे और कितना लोन मिला है, you can calculate your yield to maturity on that loan sitting at home. It's a polynomial you have to solve. It's not a simple equation. But there are algorithms, there are simple things, even on calculators I have seen, to solve a polynomial like this, where I can be solved. On calculators, scientific calculators I have seen, they have. You don't have to go to a computer even. But what I am trying to say, the concepts are very interesting and important for your understanding, particularly for economic students and non-economic students. You are also picking up something which you may require tomorrow when you join work. Somebody, your boss asked to prepare a macro note on the current state of affairs in Europe. All these variables will come into your discussion. Macroeconomics will come, yield to maturity on government bonds there, etc. will all come. All right? Okay. So on anything, now this zero coupon bond, another word is often used, please remember, is a discount bond also. Zero coupon bond has another name because it is sold at a discount, it's called a discount bond. It's also called a discount bond, and yield to maturity is of course something which you have there. So any financial instrument, if you have a return, it may be expected return if you know them and you know the current market price of these instruments, maybe secondary market price, not the primary price. You can always calculate the yield to maturity, which is an interest rate. And if the interest rate is high, it's bad news for the seller of that instrument, because the price is low and he's not getting enough. If interest rate is low, then it's a good news for the seller of these instruments, because the price is high. I can sell it at a high price. I'm selling my car. If the yield is low, I'm getting a high price for my car, what I'm saying. If the yield is high, I'm getting a low price. That is bad news. For governments, high yield is a bad news. And what they're showing on TV, if you watch now business news, foreign channels, the yield is going higher and higher every day, going up. So it's bad news for these governments. All right. Now, there used to be a very interesting item, last item I would mention while you sign on the attendance sheet, is called console, which used to be sold. I don't know if it still exists. In England, it was popular at one point. Console. Console is a bond which is sold, all right, at a price. But it doesn't have any maturity period, no maturity period mentioned, so it goes to infinity in some ways. And it has a fixed interest rate, of course, like a coupon bond. Fixed interest payment every year you have. So if you do a present discounted value of this equation, it is very interesting. P is equal to some coupon payment over 1 plus I plus C is equal to 1 plus I square plus up to infinity it will go. So, if you do a geometric sum, there is a geometric series of this infinite series, what will it be? P is equal to C over I. You will get that. All right. P is equal to C over I. It's a very simple relationship which you know from school. You will get that. These consoles are there, which I have read the first time. Maybe other countries also have it. In India, some treasury bills, which used to be known ad hoc treasury bills, have been converted into consoles, I have heard. And it pays a very funny interest payment. Who bought it is scratching their hair off. 4.84% interest or something. Even the inflation is 7%. So it's a negative real return. But what government has retired them into a console, not paid them back. I don't know whether they have redeemed them, all of them, but they used to be called ad hoc treasury bills, which became such a nuisance for the government. They stopped them issuing new ones. I will talk about that later. New ones, and they converted them into something like a console, where they will make an interest payment every year till they retire them, which is like a console, but a very funny interest rate. 4.84%, my goodness, hardly that is any return. Interest income 4.84, 7% is inflation ही है, तो real return तो negative है. Nothing. So console I first read in the context of English economy. They issued some console government. All right. Now, before I would conclude this part, interest rates, various kinds of interest rate, yield to maturity. I started out with a simple interest rate. Then you have a console interest rate. You can come. All right. Anything can have an yield to maturity and a console rate. I will conclude this part. Not in a hurry. I will do it tomorrow. All right. And then if it is done quickly, I will begin topic 2. Topic 1 is over.